All right, let's do a June/July market update. So a little late on this one. It's been an extremely interesting month and a half since the last time I did a market update. Mega cap tech has taken the baton of the market and has gone to new all-time highs. So we've talked about in prior videos where I would be looking at like an Apple. And I said, look, you could get another 20-30% higher in Apple-ish, right? 20-30% higher, maybe from the breakout level. Maybe it takes you to 160, 170. But that would be it. That would be the last gasp for tech. So I think I may have showed you in prior videos where that comes from, but I figure I'll start with it again. So value has taken a breather. Mega cap tech has taken the market to new all-time highs, but what's really interesting is the way that these mega cap names are setting up. You can see incrementally higher highs since August-ish, since August of 2020. It looks very, very familiar to this. The same pattern that developed in Microsoft prior to this move here, which was the blow off top of the dot-com bubble. So, we're in like the third leg higher here, the third incrementally higher high, and I don't know if this time is going to play out exactly like the dot-com bubble or not. But the darling of the time was Microsoft. And the darling of this time is Apple. So just keep that in mind here. I would say, hey, do you want to catch the last 20-30% in these mega cap tech names? Facebook, Apple, Amazon, Netflix, Google, Microsoft, Tesla, Nvidia, yada yada. Or do you want to get in on the ground floor, the bottoming process of value? So that's what has occurred over the last month is you've had this absolute rip. So I did the last video June, I think I did the video right around here, right around the bottom. And ever since then, we've had it topped out at 21, let's call it 22% move in Apple since I did that video. Amazon, obviously a really good run, has come back in a little bit as of late, last couple days. Google, very similar, right? Didn't even come back in yesterday like a lot of the tech names did. Tesla. It gets included in some of the stats I'm going to be showing you, but it's not doing anything like the rest of them are. This is like a clear downtrend. It's a clear descending triangle where you have equal lows, lower highs. I do think we're going to be seeing 400, anywhere between 400, 450 over the next few months. That's what I'm targeting for Tesla. Then it's a matter of if it holds there and how long it holds there for. So I really don't think I don't know if maybe the earnings is a blowout earnings, maybe it just completely negates the pattern. I don't believe this is going higher. Maybe it gets an earnings pop, but the only way this pattern gets negated is if it goes over 780 with some oomph. So that would be my line in the sand to the upside. Right now, I'm already shorted, so we'll see. So the reason why I want to start off with that is because value has taken a breather over the last 3-4 months, over the last quarter. A good way to depict that actually is just by doing this. So Microsoft, this is over the last 3 months performance. Apple almost up 10%, Amazon 5%, Google 11%, Microsoft almost 8%, Facebook at 11.5%. During that time period, energy hasn't done too bad, but some of the bigger names have pulled back, or at least going sideways during that time period. It's expected. you had the most amount of investment in the energy sector in Q1 of 2021. Just an absolute, just everybody just was diving in, just ready to go. But then the Fed came out, they said a couple of confusing things, and now everybody thinks inflation could possibly be transitory. Or at least that the Fed isn't going to be raising rates anytime soon. So, the two things that keep tech afloat is if inflation, quote unquote, is transitory, and if the Fed doesn't increase their rates anytime soon. So those are the two bullish cases for tech. I don't believe that inflation is transitory, and the Fed is going to likely have to raise rates if they don't want the economy to, quote unquote, overheat. What that means is just like if they don't want inflation to run rampant. So that's where we're at the last 3 months. And what's really interesting though is if I were to just compare the S&P year to date with Apple, Amazon, let's go Google, we'll go Facebook, we'll go Netflix, we'll go Tesla, we'll go Nvidia. And I'm showing you these for a reason because they've been included in a chart I'm going to show you later. Let me go black, and let me go start of the year. So beginning of the year to date. So you can see that the S&P 500 is outperforming from the beginning of the year Apple, Amazon, Netflix, and Tesla, but Facebook, Nvidia, and Google are outperforming the market. So in prior videos and in past years, FANG was considered, it was the acronym for the Facebook, Apple, Amazon, Netflix, Google, but the reason they had created that acronym was because these would all trade in tandem together. As one would go up, the other would. As one would go down, the others would. So now they've started to decouple a little bit, and it's really interesting to see that. And so what you have here is you have, Nvidia racing higher, Google racing higher, Facebook outpacing the S&P by about 10%, while some of these other ones have been lagging a little bit, especially Tesla. And like I said, I don't think really Tesla should ever be involved in that discussion. It's a completely different animal. Just because it has the sentiment of it, people treat it, it's a cult stock. It's practically a meme stock. If they didn't make money, it would be a meme stock. So I want to show you this as well. So the components of the NASDAQ 100, the top two components comprise about 22% of it. If you were to add Amazon, that's about 30%. If you were to add Google and Facebook, you're talking about 38%. So about 38% in the top 5 components of the NASDAQ. So as the NASDAQ's going higher, just remember that those are the components that are really dragging the NASDAQ higher. It's not it's not like every single one of these are going up with the market. It's quite the contrary. It's the breadth of the NASDAQ has been just completely garbage, which means that as the market makes new all-time highs, how many of the underlying holdings within the NASDAQ are also making new all-time highs? Very few. So you can look at names like, we'll just take like Micron, maybe Zoom, CSX is doing, it's pulling in, it's not too bad. If you look at Micron coming in, not too bad. Zoom, I haven't looked at that one in a while, but that's nowhere near its all-time highs. You could look at JD, Docu. So Docu, I'm not sure what that is. So Docu's near all-time highs. JD, nowhere near all-time highs. So you could see that, there's not many. I could go through every one of these, but I'm not going to kill you here. But it would be a sign of strength if all of these were kind of incrementally going higher and making higher highs with the NASDAQ, but that's not the case. So AMD, ISRG, I just want to look at a few of these here. Yeah, see ISRG, that's up there. Now that correlates with healthcare, so healthcare and tech tend to make that run together almost always. So that's just something to consider. So as the NASDAQ's making new all-time highs, not every single one of the components is. So when we talk about the market is making this incredible run, the underlying holdings of the market aren't exactly saying the same thing as the market is. So you have that over the last 4 or 5 months. You have IWM, the Russell, the small caps. They are going sideways, and might as well just look at the futures right now. Same chart, different symbol, and you could see sideways consolidation. So you have this big run up in small caps, and again, we've talked about how the Russell 2000, a lot of value components in it. I know a lot of people think it's split down the middle. It really isn't. So you get this, big move up, consolidation, big move up, consolidation. So we're really going through that same period that transpired between, say, August and September, August and November of 2020. We have these types of pullbacks. You can see that, from a technical perspective, make a move up, come back, kind of check that level a little bit, make a move up, come back, check that level. And since then, we've been going sideways. So a lot of the value names that we look at, like steel, same prices that we've seen back in January. CLF, same prices that we saw back in was that March, April period. We could look at aluminum and copper. Freeport-McMoRan, same price since February. Speaking of aluminum, Alcoa, same price since March. So you can see a lot of these are kind of coming in. They've had a really big run. I think a lot of people forget that. A lot of people, Alcoa hasn't made a move like this in a very long time, but since January, this thing went up 150%. So if it comes back in, 30, 40% makes sense, right? So, maybe this consolidates down a little bit, forms a wedge, maybe comes into 30 area, and it might not be a bad spot. So, other names that we look at, Helmerich and Payne Oil Company, drilling, back to February prices. If we look at ExxonMobil, back to March prices. So a lot of these companies that made that really strong dynamic move from November of 2020, ExxonMobil up 100%. Well, now it's just going sideways, and that's how it works. That's the ebb and the flow of the market. Good companies are going to consolidate. They're going to consolidate by time, or they're going to consolidate by price. If you're a really good company, pay dividends, so on and so forth, you're likely going to be consolidating by time, and that's exactly what ExxonMobil is doing. Some companies have gotten hit a little bit harder. You look at like a PBF, and this is a very good company as well. Extremely good long-term investment. This is coming back to its base, all the way back down here. Prices back to February and January prices. So even though PBF has made a little bit of a stronger run than some of the other ones have, we really, and the chart does look a little different, and it has looks like it's broken down a lot more, but we're still at prices that we saw back in February. So that's really something to consider, that even though this chart looks different than, say, ExxonMobil, right, we're still at prices that we were at in February and March. So something to consider there. SLB, Schlumberger, another oil company, back to prices that we saw back in May and even in February. So I think you get the gist of it, right? So the oil value materials, they've all came in. If we look at KRE, which is the regional banks, this has came in back to prices that we've seen in February. If you look at VFH, which is the financial sector, Vanguard, that's came back to April prices. So you've seen a lot of consolidation over the last few months, and it's really just right now, it's just a matter of figuring out when the consolidation is going to end and when the next move is going to be made. Considering the size of these moves, sometimes you have to really think about that in terms of, okay, prices really ran for the last 6-7 months coming into April and May. maybe it needs a quarter or two to kind of wear off a little bit before the next move. And that's the thing, when you're investing, it's tough to really consider that amount of time, but that's really what it takes when you look at it. You have to understand that you don't just make 100, 200% moves in the price of a stock and it just keeps going, right? Not every stock does this. These are special circumstances, right? Like when Tesla goes up that much from say November 2020 to January, 120%. That's a little bit of a special instance, right? GameStop, same thing. These moves that it's making, it's because there's something else going on that doesn't necessarily have to do with the fundamentals of the company, right? There's tons of short interest in GameStop. GameStop was, the short squeeze of what are the Wall Street bets from Reddit, getting involved. That means there's a lot of, people who are unsophisticated type traders, type investors. So the consolidation in value is good. It's good. So look at Ford, for instance. Ford's another one. Nice moves up, consolidation, nice move up, consolidation. So there's nothing wrong with that. It stinks you have to go through a period like this, 17%, maybe it goes 20% down. But that is completely normal that's completely normal action after a move like that. So I want to show you a few things there. But I also wanted to really get into some of the macro, and I'm just going to quickly talk about where we are in the macroeconomic environment from a demand perspective and a supply perspective. And the one thing that you can say it, but it's really tough to illustrate it, and I'm going to do my best now to show you some charts that will illustrate it. What the effect of trillions of dollars of stimulus has done to the global economy, but in our instance, the United States. So we introduced about $5 trillion in stimulus since the pandemic started. That triggered massive growth, but the supply lagged because we haven't been at full employment or anywhere near it. That triggered inflation, too much money chasing too few goods, which increased commodity prices, and it essentially increased the price of everything. That is all before we get hit with an infrastructure package. From everything that I see, it's going to end up between 1.5 and 3.5 trillion. I think the biggest package you get is a say yes to everything $3.5 trillion package. That has never happened. They're gonna lean this thing out. It's probably going to be anywhere between 1.5 and 3.5. So, if they say yes to everything, 3.5. If they lean it out, probably 1.5, but it could be anywhere in between. So that's on the horizon. But also that's starting, I think this month, is the child tax credit. So the prior 6 years, the monthly disposable income growth of the United States has been about $54 billion. The child tax credit is going to be introducing another $15 billion a month to about 36 million families throughout the United States. This adds a massive level of demand to where it's mostly needed. So these families are very likely need that money. So it's going to be a very, very good thing for the economy. It's going to be a very good thing for those 36 million families. People who are on the poverty line, people who are lower income and they need a little help. That's going to be huge, and because the lower income areas tend to spend a little bit more, it's most likely going to be spent very quickly. So if you take the 15, I forget what it is like 27%? 15 divided by 54. What's going on here? 15, because no lock was off, divided by 54. 27%. 28%. So you're increasing the disposable income by about 28% a month. So that's even greater demand. right? So right now, the disposable income versus consumer spending, I'm going to show you a chart on that in a second, but the income is much greater right now than the spending, and there's about 2 to 2.5 trillion worth of pent-up demand that's going to be coming through the pipeline. That again is going to be increasing growth. But the one thing to really understand is that we like to say that GDP is going to go up, but really what's happening is because 70% of GDP is consumption, we are fueling consumption, which is then in turn fueling GDP. So there is going to be a ton of consumption in the future. The M2 money supply at unbelievably historic highs. Savings rates near and at all-time highs. Massive amounts of stimulus coming through. Child tax credit. I mean, demand and growth is not going to be a problem in the future. How long all this demand and growth takes to play out, who knows? Could be 5 years, could be 10 years, but it's gonna play out over a long period of time, not over a short period of time at all. The issue right now, and the reason why prices have gone bonkers, is because supply. So we are still doing the unemployment benefit, which ends in September. And there's so much data out there on if it is or if it isn't stopping people from getting back into the workforce. It is. I don't even understand where people get the data from to try to say that it isn't. It absolutely is. Because if it wasn't, we wouldn't be having massive supply issues across the country. The reason why companies can't get out enough product is because they don't have enough people to get the product out. All right? And the other thing too, globally, that's a little bit of the case too, because you have all these materials manufacturers, you have all these producers of finished goods, and they just don't have enough people to meet demand. And that makes sense. We literally turned demand off for how many months of the pandemic, and then we told people, hey, stay home, we're going to pay you. And so now a lot of these companies, they get all these orders, all the backlog, and they can't fulfill because they don't have enough people to fulfill them. So I'm going to show you all that right now. But another point too is that all of this pent-up demand, well, it's only pent-up demand if people are confident to spend the money. And I'm going to be showing you that we do have higher consumer confidence than in past recessions. And that is a huge, huge bonus to all this. Because it's one thing if you knock the consumer down and out, if you make them, turn them into perpetual savers, turn them into non-spenders, right? Which really does happen during recessions. No, they have high consumer confidence. They know that they have faith that their income is going to go up or that's going to stay the same. They feel good about the economy, even though it's not going full speed right now. But they feel confident that the government's done everything it needs to do to get things back on track. So we have high consumer confidence, which means they're more willing to spend. On the supply side of things, so we had global trade in dollar terms at all-time highs. Just massive demand. Just huge amounts of trade going on right now. And again, this is a number that doesn't even take into account all the other stuff that's coming down the pipeline. It doesn't take into account full employment or anything like that. So just absolutely huge. We have shipping rates at all-time highs. Delivery times are at all-time highs. Unfilled orders near all-time highs. Backlogs near all-time highs, and multiple quarters of inventory build needed before supply catches up to demand. So what all this means is that producers, manufacturers are getting massive amounts of orders for goods that they're unable to fill. They're unable to fill it because they can't get the raw materials. They're unable to fill it because they don't have enough people working. to be able to fill the orders. So it is a it's creating massive backlogs of unfilled orders that will be fulfilled in the future. And something to consider as well is that you wouldn't have a backlog if there was plenty of inventory. But the pandemic essentially stripped inventory out of everywhere. So now what you need is, you don't only need supply to catch up to demand, but you need supply, or you need these manufacturers to rebuild their inventory. So they need to get their inventory back up to levels where they can confidently fulfill orders. They're not there yet, and they're not going to be there for 2 or 3 quarters from now at minimum. So that's something to really consider, is that this isn't a supply issue that's, obviously we've had a supply issue now for the better part of the last 12 months, but the supply issue isn't just going to stop once September and the unemployment benefits stop, right? Like, just because people have the opportunity to go back to work doesn't mean all of a sudden all of the supply concerns go away. No, this is going to take many quarters to be able to catch back up to demand and to catch back up to the inventory needed to sustain certain levels. So that's something to really consider on the demand and supply side. So demand isn't a problem. Supply is going to be a problem for a little bit longer. And by a little bit longer, I mean quarters worth, but it's going to take a while. So supply is continuing to lag. This is the chart for the disposable income. So what you have here is you have the disposable income, and then you have consumer spending. So you could see that income levels are well above compared to historical norms. And what that really does is it creates a savings rate. So you have all this income here. That's all your spending of it, and the gap between is the savings rate. So you have about 2 to 2.5 trillion worth of pent-up demand, and because consumer confidence is high, there's a good chance that it gets spent in the future, which continues to fuel demand, which continues to fuel GDP growth. Here's consumer confidence. So the gray shaded areas are past recessions. You could see that how low consumer confidence got during those time periods. You'll notice that this recession was much different. Consumer confidence never got to those levels. It never got to the levels of the global financial crisis. It never got to the levels of the early 90s, and it never got to the levels of 1980. So you could see that consumer confidence remains high. It's trending in the right direction. Which means that a lot of that savings, a lot of that pent-up demand will likely get spent in the future. Industrial production. So you could see here that we had topped out in January, February of 2020, and it's shaken right now, right? So there's going to be fits and starts to it. This is mining, quarrying, oil and gas extraction. You have to remember too that you're going to need incentive for companies to increase production. So if you think about a legacy, let's call it legacy aluminum producer, or legacy oil exploration company, right? Or drilling company. You have all of this infrastructure. You have all this production that you can turn online. But the price of oil is above where it was in 2018. So if you turn production on, that increases supply. If you increase supply, that could bring down the price of oil. If you bring down the price of oil, you make less. So there's not really much incentive right now to rush to start turning production back on, because you already have the infrastructure to produce as much oil as you want. So the higher the price of oil stays, the more money you make, the higher margins you make. So there's going to need to be incentive. Oil's going to have to stay at these levels for a while. I'll make a case later that we're going to be seeing $100 a barrel. If not by the end of September this year, then definitely by summer of next year. So that is So basically what I'm saying here is that production isn't getting back up yet. It's not getting back up because of labor shortages. It's not getting back up because of there needs to be more quarters of higher prices in commodities. Jobs market. So this is total amount of employed people within the economy, and you can see we're back at about 2017, 2018 levels. So we're nowhere near back to where we were before we started fueling the economy with all the stimulus. So just imagine where this can go. Job openings way above, way above where we were at the peak in 2018 and 2019, and well above where we were January, February of 2020. So just think about this in terms of this, and then you can really understand that, once September passes and the unemployment benefits are cut off and people are going to start looking for work, and there's going to be plenty of job openings for them to take, and it's just going to be a matter of time until we surpass the January 2020 levels of employment in this country. But what's going to be really interesting is to see where this goes after that. One thing on housing here, just because I know a lot of people are interested in housing, you can see that our supply curve is starting to get back up. So we bottomed out in the latter half of 2020, and we started kind of really turning up in 2021. We are nowhere close to the I guess you could say we're back at levels that we've seen in maybe late 2019, but you could see that during this time period, we were all the way up here, and now we're down here. So supply has a while to go to get back, but it is alleviating some pressure on prices, where prices for houses were just unbelievable for quite an amount of time, but it's alleviating a little bit of pressure now because supply is coming back in. A quick note on value and crude. So crude oil has continued to go higher, and we could just, I guess, talk about some commodities here just to really paint the full picture. But so lumber, right? Lumber's kind of made all the way up to the moon and all the way back. But what is going to be really interesting to see, so here's your bottom. That's your bottom of where the pandemic started, okay? We're 2 times higher than that level, but what's going to be really interesting to see is where this settles. So I don't think that lumber is just going to come all the way back down to the March 2020 levels. I think it's going to be fine. It's going to base somewhere around this, say, 375 to 550 level. I think that's where it's going to settle in, which if it does do that, you really want to see if it's going to settle above, kind of the base that's been formed over all these years. You can imagine with inflation, it should, right? So this is, if it settles above this area, that 400 level, that's going to be what's really interesting. A lot of other commodities have kind of pulled back a little bit. So you could see copper has pulled back. I think this is going to do something like this. We shall see. But copper's made an absolutely incredible run since the March 2020 low, up about 145% since then. It's given a little back now. But again, a lot of this is just, hey, the supply was so constrained for so long, and now it's releasing a little bit. So there's a little bit of supply coming back on, kind of across all the commodity space. So that's obviously going to bring prices down a little bit, but demand is going to continue to outpace supply. And that's why I think copper stays at these levels, if not goes higher. So what that means here is that you have crude Crude's continued to go higher. You can see from this chart here, it's from March to say May. It was going sideways, but then it broke out higher. What's going to be interesting here is if it stays above kind of the 70 level or stays in the high 60s. Oil companies, producers, drillers are extremely profitable at these levels. They're even more profitable when we get into the high 70s, 80s, 90s, $100 a barrel range. But right now, they're extremely profitable. They don't have to turn on production if they don't want to. The government is literally telling financial companies not to like lend money to oil companies that want to increase production and build more drills and things like that. So a lot of these companies don't have to increase supply. They are being disincentivized to increase supply, to increase their capex to build out production. So I don't know how oil would be going back down to levels that we saw in 2020. I think there's too much demand, too much growth, and supply is going to be capped. And that's going to keep oil in at these levels, if not higher. So I do believe that we are going to see $100 a barrel again, if not higher. The peak for oil was 2008 at about 147 a barrel. So that's a little too hot. But just like when we were saying lumber settles low, I'll be interested to see if crude will be settling higher. And somewhere in the high 70s, the 80s, the 90s, it's going to be really interesting to see where this settles. I don't know if we're going to see another one of these off to the races 150 plus moves, but we'll see where this goes. I just do not see how oil could go down. And when I show you this, the reason I'm showing you this is because crude oil is orange and value minus growth is black. And what value minus growth means is that growth has been outpacing value, hence the line heading lower. During that time period, crude's been going higher, and because oil and energy is such a big part of value, something's got to give here. At some point, these oil companies are going to catch up to that price. So if you look at an ExxonMobil and compare it to crude, and we do it since that time frame, so say we do it since March or whatever, you could see that crude has been outpacing Exxon. In most cases, over historically, they do correlate. Not 100% correlation, but they do correlate. Meaning as the price of oil goes up, Exxon should go up and vice versa. But during a period like this, that should be even more. There should be even more correlation, because companies like Exxon, companies like Helmerich and Payne, companies like Baker Hughes, Schlumberger, Halliburton, these companies haven't seen high oil prices in a long time. So if we get back above, if I just bring up a chart of crude. So let's go weekly here. So they've had lower oil prices all this time, right? Oil's been going down. So back in 2016, it was 20 something a barrel, and it got up to 40, and then it popped to 70 something, and then back all the way back down. So over the last 5, 6, 7, 8 years, they've had to deal with low oil prices. They had that initial period after the global financial crisis where they got back above 100, and then ever since 2014, it's just been down. So we've been in a low inflation environment for a decade. If we do get inflation and we get a ton of growth, oil is going higher. And it's just a matter of how much lag there will be on oil producers? That's going to be the question. So another one of the things I wanted to show you was this, which I had mentioned earlier in the video. So Apple, Amazon, Facebook, Google, Microsoft, Netflix, Nvidia, Tesla comprise 27.17% of the S&P 500. In past times, I've shown you this where it was about 22%, but this one didn't have Nvidia and Tesla in it. The point is that that's more than a quarter of the market comprised in 8 different stocks. And I could just show you this again, but we've gone over it. And when the market goes higher, it's really just these companies that's dragging it higher. And that is not a sign of a healthy market. And one of the things that's being done right now is a lot of these mega cap tech names like an Apple, because it has so much cash on hand and because it is, such a part of our day-to-day life, and it's one of the best companies in the world, it's a flight to safety. So that is really one of the things that has propelled it higher. So we've talked about this, how this chart's just out of control at this point. One of the lessons that you can learn from this is that it almost doesn't. Sometimes it's better to find a company like this and be risk on than be smart and be risk off. Because no matter how high I thought this was going to go, it was going to go higher, right? So in this environment, it almost pays to not have any, maybe experience, but in this type of environment over the last 2 or 3 years, it pays to never have looked at a chart of Apple, right? Because if you looked at a chart here, you wouldn't have got into it. If you looked at a chart here or here, you wouldn't have never got into it, and you would have been worse. You would have been worse off for it. So right now, I'm going to say the same thing I would have said back here, and look, at some point, this is going to turn into the Microsoft of 1999 and 2000. It just is. I know it's tough to believe, but I'm sure if I was trading and if I was investing back then, I would have thought this was the high, and I would have thought this was the high, and I would have thought that was the high, and I would have thought that was the high. And that's why it really pays. It doesn't pay in these types of markets to call tops, because there's always another top to come. So just keep that in mind. If you do own Apple, if you do own Amazon, high levels of risk here. Very, very high levels of risk being involved at these prices. Just keep that in mind. So I think that covers everything. So a little bit of macro, a little bit of market update. So value has taken a breather over the last 4 or 5 months. Value, technology and mega cap stocks have led the market higher. That's where we're at right now, just about all-time highs. And everything seems all right, right? Plenty of growth, plenty of demand. September's around the corner. Once the unemployment benefit goes away, we'll see how many people come back into the labor force. We'll see how much supply constraint gets relieved. Child tax credit. I mean, we're going to go through a very incredible period of growth and demand in this country, and I think it's extremely exciting. I know there's people who are very worried about what happens on the back end of this. All the debt that we have, the deficit we keep running, scared of inflation. I think you should be. I don't think now is the time, but it's funny because I've talked to clients and they said, well, they lived through the dot-com bubble, they lived through the global financial crisis, and hearing me say, oh, it's not it's not going to happen now, it's going to happen later, it rings a bell with them. And I think that's very interesting. I think that I can't see it. Like, I can't see how you could have all this demand, all this growth that's going to be coming into the economy, and then we get a crash. Also, you don't normally get, the dot-com bubble and then the global financial crisis following up 2 recessions in less than 10 years. That is so rare. So rare. That normally doesn't happen. In 20-year, 30-year cycles, you get 1, maybe 2. Well, right now, this is the first one we've had since maybe 11 years, right? 12 years, 13 years. So you don't normally have another one right after it. So that's something you really have to consider. I mean, this market looks silly at this point. I get that. But you don't normally get another recession a year or 2 or 3 after the one you just had. But history could be made. So I think when it comes to the market, I think that's why we're going to be getting a rotation. Because I think, especially in the next couple weeks with a lot of materials and energy companies reporting earnings, I think you're really going to see how profitable these companies can be with higher commodity prices. And I think that's going to really... So all the people that invested in, that rushed into energy the first quarter of 2021, they pumped the brake for the next 4 or 5 months. But now I think this is really going to prove that, hey, profitability is going to be going up, and it's not just going to be going up for a quarter. It's going to be going up for 2, 3, 4, 5, 6, 7, 8, 9, 10 years. And that is something that I think the institutional investors are going to, if they don't already know it and they're just kind of waiting, that's another thing to really consider too, is that I can show you all the macro data, and the macro data says buy value all day long. It says dive headfirst into value. But if the investment community doesn't believe it, then it doesn't mean anything, right? If investors don't believe that inflation is here to stay, they're not going to put money in value. And that means value stocks are going to lag. So just always understand there's 2 sides of it, the macro side, the investment side. Macro aligns, the investment side needs to come in a line as well. So these are all things to keep in mind. Nothing has changed in my opinion. 3, 4, 5 months of consolidation, it happens. It hasn't been the best trading environment, especially for me, because I've been a little tunnel vision on. I've been really focusing on hitting value out of the park every time it makes a run. Each one of these moves up was an incredible run for me in my trading account, and now I get the back end of that. And so trading is about survival, investing is about time. So as most people who are on this thread are investors, you really have to zoom out and look at the long-term picture of this, right? You could buy Baker Hughes for $20, maybe under $20 this week, and if oil prices get back to where they were, even in 2012, 2013 at say 100, which, then that is where Baker Hughes can go. Same thing with Exxon. If we get back to $100 a barrel, well, Exxon has a runway to about 100. Schlumberger, same thing. You could buy it down here. So if you really don't believe there's a lot of demand, or if you think there's going to be plenty of supply, it's going to keep prices down, then I can completely understand. But I think a lot of that stuff is, I think now more than ever, with all the data that's come out, it's our runway for growth is very long, and supply is going to have a hard time catching up with the amount of growth and demand that's going to be in the economies of the world, and oil, I think, is going to have a very, very clear path to 100 plus a barrel. So So I think that's it. Alrighty. Hopefully everybody enjoyed this June-July market update. As always, if you have any questions, shoot me an email, and take care.